Welcome back, awesome people. In today's episode, I'll be going over the 6 different types of stocks that you can add to your portfolio, both for diversification and passive income. And you can buy all these different stocks through your Robinhood or Wealthsimple Trade platform. And if you want free money to trade with and $0 commission fees that won't eat into your profits, sign up with my Wealthsimple link down in the description box below for $25 of free real money to trade with. Link is below. So when people say, I am buying stocks, many don't ask what kind of stocks are you buying. The usual questions are what company and how many shares at what price. Of course, those are important information, but it is also good information to know as to what kind of stock it is. Is it a growth stock, a dividend stock, a speculative stock, etc.? So let's get into it. But first, get bullish on that subscribe button and smash all the likes, bells, and whistles so you will be able to get all my updates on these fantastic investments. And comment below with what you think, because I do reply to every comment. So here are the 6 types of stocks that you can buy and what they mean for your portfolio. First is the blue chip stocks. Blue chip stocks are almost always massive companies with an excellent reputation. These are typically large, well-established, and financially sound companies that have been operating for many years and have dependable earnings and often paying dividends to investors. A blue chip stock usually has a market capitalization in the billions and is generally the market leader or among the top 3 companies in its sector, and is almost always a household name. For all these reasons, blue chip stocks are among the most popular to buy among investors. Some examples of blue chip stocks are IBM, Coca-Cola, and so on. Now, while dividend payments are not absolutely necessary for a stock to be considered a blue chip, most blue chip stocks do have long records of paying stable or rising dividends. I personally started investing buying blue chip stocks. My first 3 companies I purchased ever were Coca-Cola because of its global dominance in the beverage sector, AT&T because of all the reach that it has in many sectors in and out of communications, and Iron Mountain. It's a stock that many don't hear about, but Iron Mountain because it has a global monopoly in secure physical storage and is used by more than 80% of the companies on the Forbes 500. So these companies have a very slim chance of going under and have made many changes to adapt to their sector's future landscape. Plus, they pay an excellent dividend. Second are growth and value stocks. Growth stocks are shares in a company that is anticipated to grow at a rate significantly above the average growth for the market. These stocks generally do not pay dividends. This is because the issuers or the companies of growth stocks are usually companies that want to reinvest any earnings that they make in order to accelerate growth in the short term. When investors invest in growth stocks, they anticipate that they will earn money through capital gains when they eventually sell their shares in the future. Simply put, these are stocks that you believe it will continue growing. And an example of these type of stocks are Tesla and Amazon. And value stocks differ from growth stocks as investors expect growth stocks to earn substantial capital gains as a result of strong growth in the underlying company, whereas value stocks are often underrated or ignored by the market, and they will have very minimal drastic movements in their share prices. Most importantly, investors aim to profit from the dividends that value stocks typically pay. Value stocks are more similar to blue chip stocks and include companies like Verizon and Walmart. Many investors, including myself, will include both growth and value stocks in our portfolios for diversification, and others may prefer to focus only on one. So choose what's best for your portfolio. Some value stocks are underpriced simply due to poor earning reports or negative media attention. However, one characteristic that they often have is strong dividend payout histories. Now, a value stock with a strong dividend track record can provide reliable income to an investor. And many value stocks are older companies that can be counted on to stay in business, even if they aren't particularly innovative or poised to make a big growth. And this leads us into our third type of stock, the dividend-focused stock. Simply put, a dividend is the distribution of some of its company's earnings to its shareholders. And if you want more details on dividend-paying stocks and how you can maximize your potential by buying dividend-paying stocks, watch my video that I posted titled Buying Dividend Stocks. And in that video, I highlight strategies and tips that you can use to better build your dividend portfolio. Now, dividends can be paid out as cash or in the form of additional stock. Dividends can be expected by the shareholders as a reward for their trust in a company. The company management may aim to honor this sentiment by delivering a robust track record of dividend payments. Dividend payments reflect positively on a company and helps maintain investors' trust. Dividends are also preferred by shareholders because they are treated as tax-free income for shareholders in many countries. If a company has a long history of dividend payments, a reduction of the dividend amount or its elimination may signal to investors that the company is in trouble. However, not always is a reduction in dividend amount or a decision against making any dividend payment may translate into bad news about a company. It may be possible that the company's management has better plans for investing that money, given its financials and operations. For example, a company's management may choose to invest in a high return project that has the potential to magnify returns for shareholders in the long run, as compared to the petty gains they will realize through dividend payments. Now our fourth type of stock. Our fourth type of stock is cyclical stocks. Now cyclical stocks price is affected by macroeconomic or systematic changes in the overall economy. Cyclical stocks are known for following the cycles of an economy through expansion, peak, recession, and recovery. And many involve companies that sell consumer discretionary items that consumers buy more during a booming economy and buy less in a receding economy. Cyclical stocks are generally the opposite of defensive stocks. They include discretionary companies such as Starbucks or Nike, while defensive stocks are staples such as Campbell's Soup. Cyclical stocks usually have higher volatility as well and are expected to produce higher returns during periods of economic strength. And our fifth type of stock is a defensive stock. As I just mentioned, it is the opposite of a cyclical stock. So a defensive stock, which is a stock that provides consistent dividends and stable earnings regardless of the state of the overall stock market, there is a constant demand for their products. So defensive stocks tend to be more stable during the various phases of the business cycle. Now, people always get this confused. Defensive stocks should not be confused with defense stocks, which are the stocks of companies that manufacture things like weapons, ammunition, and fighter jets. A defensive stock is a stock that provides consistent dividends and stable earnings, regardless of the state of the overall stock market. It is very similar to blue chip stocks, as they are well-established companies, such as Procter & Gamble, Johnson & Johnson, Philip Morris International, and of course, Coca-Cola. And Warren Buffett also became one of the greatest investors of all time, in part by focusing on defensive stocks. It is not necessary to take excessive risks to beat the market. In fact, limiting losses with defensive stocks may be more effective. And finally, the sixth type of stock, speculative stocks. Now, speculative stocks may be a penny stock or an emerging market stock that the trader expects to become much better known very soon. Most traders, or many traders, are drawn to speculative stocks due to their higher volatility relative compared to the blue chip stocks, as speculative stocks create an opportunity to generate greater returns at a greater risk. Most long-term investors and institutional investors stay away from speculative stocks unless they are part of a mutual fund or an ETF. And speculative stocks generally do outperform in very very strong bull markets, when investors have abundant risk tolerance. They underperform in bear markets because investors' risk aversion causes them to gravitate towards larger cap stocks that are more stable and pay a dividend, just like kind of in the current climate that we're in. And also, speculative stocks often account for a small portion of portfolios held by experienced investors because such stocks may improve the return prospects for the overall portfolio without adding too much risk, thanks to the beneficial effects of diversification. Experienced investors who dabble in speculative stocks typically look for companies that have good management teams, strong balance sheets, and an excellent long-term business prospects. However, most investors should avoid speculative stocks unless they have time to dedicate to researching the company. So, my awesome people, I have highlighted the 6 types of stocks that you can buy on the market and for different reasons. I tend to make my portfolio heavier on the long-term side as I am about 70% invested in strong, stable, dividend-paying value companies, and the other 30% is invested in speculative and growth companies. This diversification allows for a long-term passive income that I will continuously receive and small fund trades that will make me a return in the short term. So whatever type of stocks that you do decide to buy, make sure you do your own due diligence and research, because there will always be a risk in anything and everything that you invest in. And if you want to know exactly what speculative stocks that I am buying, follow me on my Twitter account at Jacob Rant, where you will see my daily buys and sells. And if you have not started investing and don't know where to start, sign up with my Wealthsimple Trade link down below. You will get free money to trade with, as well as you will get $25 of real money to trade with and $0 commission fees that won't eat into your profits. So sign up with my Wealthsimple link down in the description box below for your free $25 to trade with. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to wealth and the key to financial success. Subscribe, like, and share to help out the channel, and so you will get notified of when I go on YouTube Live or of my recent posts, as I will be posting my penny stocks, REITs, dividends, and speculative stocks from my portfolio and investments that I am currently buying and selling. And also follow me on Twitter at Jacob Rant so you can see my daily plays. Also, check out my recent update of my journey of turning $100 into $1,000 through my Wealthsimple Trade app. So subscribe. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride 2021 together on a journey of health, love, success. So until the next video, stay ranting.